Hello, everybody. Welcome to our Wednesday session, Fuqua Live on LinkedIn. As you know, every Wednesday, Fuqua faculty is coming to you live on LinkedIn to talk about how our research helps understand current issues. So in today's session, I will be talking about the Fed and financial markets in the times of a pandemic. My name is Anna Cieslak. I'm an associate professor of finance at Fuqua. I've been at Duke since 2015. I am also affiliated with the National Bureau of Economic Research, and I've been a research fellow at the Bank for International Settlements. This is the central bank of central banks. At the end of the session, I will be taking your questions, so please leave them in the comments section below. All right, so let us talk about today's topic. That is the Fed in the era of the pandemic. So I want to talk about how the US central bank, that is the Fed for short, has responded to the pandemic and what effect it has had on financial markets. This topic is close to my heart because in my research I study how monetary policy, how the Fed interacts with both Wall Street and Main Street. So the two questions that I've been particularly interested in is, one, how much does the Fed influence stock and bond prices, that is financial markets? And then parallel question that I've been interested in, number two, is how much does the Fed actually respond to financial markets? And if they do, then why are they doing it? If you want to put it briefly, the question is the Fed actually trying to bail out Wall Street? So what I will want to do today is to put the current events in the context of some of the research that I have done. And before we jump into that, I think it is useful to think about actually what happened in financial markets. And here a plot may be useful, so let me briefly share my screen with you and show you a plot that tells a story. So this is the US stock market. From about a year ago up to about today. This is the S&P 500 index, and we had a pretty good ride, if you look at it, until February. And in late February, March, things started to happen. In a span of several days, the stock market lost 33% of its value. This is very significant. It's comparable to what happened during the major crisis, including the global financial crisis of 2008 and 2009. And other asset markets were affected as well with severe disruptions, not just the stock market. So what happened to credit spreads, that is the cost of borrowing for firms, skyrocketed. About 200 basis points or 2 percentage points increase, again in a span of a couple of weeks. And also the volatility in financial markets went through the roof, which you can see in this graph. Now, going back to the stock market, interesting things started to happen in late March. So after this dramatic decline, what we have observed is systematic recovery. And it is not a coincidence that on March 23rd, the Fed came up with a very significant announcement, which was followed after a couple of days with an announcement of a broad fiscal stimulus as well. So both monetary and fiscal policies were working to provide support for the economy in the time of the pandemic. And the Fed has reinforced the initial announcement with additional measures that I want to talk about. And you can see this has led to a very significant rebound in the stock market and decline in the cost of financing for firms. Okay, so what does that mean? So how should we think about the financial markets developments during that early period and then the recovery? So what is really interesting about the financial markets is that they responded dramatically to COVID before stress could be detected in macroeconomic data. before we knew how bad unemployment is, before we knew how bad GDP looks like, we had these very strong declines in the stock market and disruptions in other financial markets. Sure, now we know, using just macroeconomic data, that the situation has been bad and is bad currently, that we lost 20 million jobs, that unemployment increased 10 percentage points from historically low to historically high. But this data was not available in March, when the stock market was dropping dramatically. So the important lesson here is that financial markets are forward-looking. That is, they reflect, on the one hand side, the outlook that market participants have for the economy going forward. They reflect people's expectations, they aggregate them. And the second very important component is also that financial markets, in addition to reflecting expectations, they also reflect fears. That is, reflect the risk aversion of market participants. Both of these effects were playing a significant role during this early phase of the pandemic, where we saw very steep declines in asset prices. Both of these components are important. So you may wonder, okay, so given this big decline, how do we actually understand whether it stemmed from really dramatically bad outlook or really dramatic increases in uncertainty that have driven additional declines compared just to pure outlook? So actually, I have spent some time thinking about this question, how to decompose the variation in asset prices to learn what shocked financial markets. What are the sources of the declines? So let me just show you a brief plot that does a decomposition like that, trying to answer the question, what is the shock? This is based on my recent work with a PhD student at Fuqua, Haopang. And our goal was essentially to dissect recent developments into sources. So in this plot, you see the cumulative returns on the S&P 500 index in the US from early January through end of March. And this is the 33% decline that I just talked about. Superimposed as vertical lines, you can see important events. Now, we asked the question in this paper, how important were beliefs of people just about the outlook, that is deteriorating economic expectations, vis-a-vis enormous uncertainty that essentially blew up in that period and added to people's risk aversion? So here's the result. In terms of the overall decline, about 8% of the decline came from people's downgrading their expectations about the US economy. About twice as much came from the added effect of uncertainty about outlook. It's not just it is going to be bad. We know it's going to be relatively bad, but the uncertainty about the outlook is humongous. And this has led to what we call flight to safety, or people dumping risky assets in favor of safe assets. And this exacerbated the declines that we have observed in financial markets. If you think about what the Fed did in the initial phase, they responded aggressively using their standard tool. They said, we are cutting interest rates. We are cutting them down to zero. This helped, but it helped only to counter about 4% of the overall decline. This is the blue line that is showing you the effect of Fed promising and cutting interest rates and promising to keep them low going forward. And then what happened next? You see this increase coming in the late March, from March 23rd. The Fed started using additional tools in their toolkit to support the economy. And I want to talk about exactly the tools that they've been using to counter the downturn and then promote the run-up that we have seen in subsequent weeks. Let me first start by telling you a little bit about the overall philosophy that the Fed has. So obviously the Fed is acting under a mandate. We call it a dual mandate, which is to promote maximum employment and price stability. That is, keep inflation in check, okay? Now, when you look at the data that I have just shown you and take into account the fact that the Fed reacted aggressively before any signs of disruptions were seen in economic data themselves, you could conclude, well, the Fed is bailing out Wall Street. So we actually studied this question in some depth. Is the Fed trying to bail out Wall Street? This is the question that we asked in my joint work with my co-author, Annette Wissing from Berkeley, titled The Economics of the Fed Put. And what we have found is that the Fed pays significant attention to the stock market, but it doesn't do it for the sake of just rescuing Wall Street. If you want to summarize of what the Fed is doing, it's useful to remind ourselves of what the former chair of the Fed, Bernd Bernanke, said in the context of the global financial crisis. He said, we didn't set out to save Wall Street, but in order to save Main Street, we had to save Wall Street. So now the question is, in the sophisticated logic of the Fed, why would the Fed care about the stock market? And the first reason is what I already alluded to. Stock market reflects beliefs or expectations of millions of investors, so it's a good source of information about the economic outlook. That's one natural source of information that the Fed could resort to understand what is going on. But in that paper, we have found that far more important is a different effect. It's a direct effect of the stock market that it has on the real economy. And this direct effect is what people in economics call consumption wealth effect. So here is how it works. Suppose the stock market goes down as it did in February and March. What will happen to you as a consumer? Well, your wealth goes down if you hold stocks. You feel poorer. What is your response? Well, your confidence as a consumer goes down. You spend less. Spending goes down. Consumption goes down. Consumption is a very important component of GDP. So with such a development, we are essentially heading towards a recession. Fed believes that we should be countering this effect with stimulation, with providing boost to consumer confidence, reducing risk aversion, reducing risk premia in the economy in order to stimulate demand. And in our related work, we have found that, in fact, the most significant effect that the Fed has on financial markets is not through directly cutting interest rates. Is actually by reducing the risk premia on risky assets, that is boosting confidence, boosting risk appetite, promoting risk-taking in certain way. And when I say promoting risk-taking, I mean it in a positive way, that is making people more willing to take on risks. Okay. So what specifically, given this philosophy, this framework that the Fed has, what specifically have they done to counter the declines in asset prices, in financial markets that we observed? So the first thing that they did is, as I mentioned, their standard tool, that is cutting interest rates down to zero, and then providing what is called forward guidance that says we are going to maintain very low zero interest rates for an extended period of time. They did it first, but this was not all that drove the recovery. On March 23rd, the Fed announced the first part of their program to stimulate the economy. And what are the components of this program? Well, they go far beyond just cutting interest rates. A lot of the tools that Fed promised to deploy at that point came from the 2008-2009 financial crisis playbook. But there were new tools as well. What are these tools? They are buying assets. So the Fed started buying financial assets. In particular, they started by buying treasury bonds. So why does the Fed buy assets? If there is a big player that comes into the market and buys stuff, this means that the prices of these assets will go up. Well, we have just seen that prices of some assets went dramatically down. So in certain way, the Fed is trying to counter this particular decline. And they've been achieving this through initially what is called quantitative easing, that is buying treasury debt and buying agency-backed mortgage-backed securities. But this is not where they stopped. And here is where new policies come into play during the COVID pandemic that were not used before, or not to the same degree used before. So the Fed started intervening, promised interventions in credit markets on an unprecedented scale. So they promised to support Main Street through Main Street lending program, as well as larger corporations with corporate lending programs. And what is important to realize here is that whenever Fed promises to extend credit, these are not gifts, these are loans. The Fed cannot lend to bankrupt firms. They are just not allowed to do it under the Fed Act. They can only lend to firms in good standing in exchange for high quality collateral. And the scope of these interventions that were promised in March and early April, and then reinforced subsequently, is very large. Fed could tap into about $4 trillion of resources to be lending to corporations. And they obtained about 10% of that $4 trillion in form of backing from the Treasury in order to absorb any potential losses. So I want to just give you a sense of how significant this intervention is. And let me just share quickly my screen again to illustrate that. So as I mentioned, the first and standard tool was to slash interest rates. So we've been in a low interest rate environment for quite a long time following the financial crisis. We started to get out of it end of 2015, where the Fed started to tighten interest rates. Now, from 2019, we had a couple of easings, but what really happened in March were emergency cuts that happened very quickly, very radically, that brought interest rates down to zero. This is one standard tool that the Fed has been using for many, many years in the past. The second tool that I mentioned to you is buying assets directly. This is what we call expansion of the Fed's balance sheet. And this is the part that has been really, really big during the COVID crisis. So what this chart is showing you is trillions of dollars. So these numbers, 4 here means $4 trillion. This is the size of the balance sheet that the Fed has. This is how many assets they are holding, what's the value of assets that they are holding. And what you can see toward the end of the graph, up to very recently, that this balance sheet has expanded dramatically from $4.5 trillion to more than $7 trillion in a span of just a few weeks. And I just want to give you a sense how radical, how large this intervention is, and compare it to what we thought was an enormous intervention in 2008. So this graph extends the former plot to show you the 2008 crisis. This was an expansion of the balance sheet. It was significant. Fed was buying a lot of assets. But when you compare this expansion with the current expansion, it becomes apparent that the current intervention is unprecedented. So what has this achieved? We have seen asset values going back to where they were, almost where they were before COVID pandemic. So the Fed has been able to reassure the markets, restore the confidence. It looks like risk premia in financial markets have retracted. Since March 23rd, every single stock until June in S&P 500 index delivered positive returns. So it looks like the Fed has been, and in combination with the fiscal stimulus, they have been successful in averting some of that decline. But going forward, obviously, all open questions remain. And there are two types of uncertainty. Uncertainty about the economic outlook is very significant currently, and I want to tell you a little bit more about it in a second. There is another source of uncertainty, which is about the consequences of these bold policy moves going forward in the longer term. So we know that the 2020 is going to be bad in terms of real GDP growth. It looks, however, that what is even more important about what's going to happen next is that we simply don't know what it's going to be. Uncertainty is very, very large. And I want to leave you with one plot again that comes from Fed's own projections for the US economy that were released on June 10th, 2020, so just a few days ago. So what this plot is telling you is what happened in the past, or from 2015 to real GDP growth, about 2% stable. What is expected to be the final number for 2020, and private sector forecasters agree, is going to be bad. We already know it's quite bad, about 6.5% negative growth rate. That's significant. And we sort of, when you look at this chart, we sort of agree that it is going to be bad. How do we know we agree? Well, the dispersion of these forecasts is limited, as you can see. But now move to the forecast for the next year. And here is what is interesting about this. On average, Fed and also private sector expect a strong rebound, about 4.5%. Next year, 2021. But what is striking about this forecast is the amount of uncertainty that it conveys. These uncertainty bounds say that scenarios between being at -1% real GDP growth and +7% real GDP growth are actually something that we believe could happen. And this uncertainty will have consequences. What it will mean in particular, and this is becoming clear from Fed's recent announcements, is that monetary policy is going to remain very accommodative going forward, at least until 2022. This is essentially what we are going to face for subsequent at least 2 years. So I would like to thank you at this point for your attention, and I will leave it at the statement that uncertainty about outlook and consequences for policies are very significant at this point. And if you are interested in my research, follow the link below to my personal website to learn more about it. Next week, we are going to have Christine Moorman talking about marketing during the pandemic. So follow us on LinkedIn Live to get an alert when our streaming begins. And now I will open the floor for some questions. All right, so Perfect. So we have some questions here that are highly relevant. So one question is, if all the cash being pumped into the economy, could we see significant inflation? And this is a very important question, the question that comes again and again in conversations. So just to be clear, at this point, inflation doesn't seem to be on most people's minds. It seems that, if anything, we are fearing about deflation or too low of inflation. So you can see it in a number of ways. We've been lowballing the Fed target for inflation, which is 2%, for a relatively long time. And currently, despite this intervention, long-term inflation expectations are still suggesting we are at or below the target. This is both confirmed in private sector expectations as well as in financial markets in the so-called break-evens. So it doesn't seem to be the dominant concern, and we know that there have been deflationary pressures coming from the pandemic, but it will become a concern potentially in situations where, given that the fiscal stimulus has been also very significant. So it doesn't seem to be a primary concern right now. If anything, there is a bias towards deflation, but it could arise as an issue going forward. Perfect. I will take another question. How much of US consumption is tied to Americans who have large portions of wealth in equities? So in the US, about 50% of the population would be holding, either directly or indirectly, of households would be holding equities. And this is actually a very important question. In fact, when we were studying the Fed perceptions of the stock market and its potential response to the stock market, this was a primary question for us. Okay, you believe in consumption wealth effect, but what are the distributional effects of this belief, given that not everybody holds equities? And what we do find is that people who do respond to the stock market in a significant way in terms of consumption, these are those people who do own stocks, but there could be indirect effects also coming that are at play for people who do not hold stocks, but through labor market expectations and confidence itself could spill onto the part of the population that are not stockholders. So this is an important consideration, going forward. There is a question: what are the long-run consequences of stock prices of bringing the Fed balance sheet back to the pre-global financial crisis level? Do you have a sense of the magnitude of the price impact? My sense is that going back to the pre-financial crisis level with the balance sheet will be very hard, at least in midterm. I don't have a sense of what it would take, but currently moving away from the high balance sheet doesn't seem like being an immediate possibility. All right, so I will thank you for your questions, for your attention at this point, and I hope that you will be joining us systematically for the future sessions where we talk about how our research helps understand what is going on in real life. Thank you very much.